This is Ray Petit doing the virtual workshop. So if you need anything at all, anything that we share today, just get a hold of me at the email that's on the screen and we'll go from there. And what I wanted to do was actually show you how powerful we've actually made the system since last time you may have visited with us. So hopefully you will see that the number of things we can do is just amazing. And what I'm excited about is that this happened because of you, the client. The client asked for something. We'd never thought of it. We did it. Now we're doing it for many of you. So if you see something you like, please ask us. We're here to serve and to be of service to you. So very first thing I'm going to do, we're going to go back to one of our originals right here. And this is the Minnesota chiropractor that many of you have seen and learned from. But I'm going to show you how money recirculates. Actually, through this program, I'm going to go in detail. So it might be a little burdensome. I didn't want to make it that way, but I wanted you to capture how banking is so much more important than just putting money in and buying big things and various things. So the very first thing I want you to realize on this individual has 15 third-party debts, and we're going to number them. 1, 2, 3, 4, 5, 6, 7, 8, 9. Page 1. Now we go to page 2. There's Sears card again. 10, 11, 12, 13, 14, 15. Now, I don't want any of you making fun of my handwriting or numbers. I'm just trying to be efficient here and I'm not trying to get a grade on it from a teacher. But if you want to be my teacher, go ahead. So we have 15 third-party debts. And one of the things I want you to realize, those total $421,000. And this individual said that he could pay $20,000 a year. So 20,000 into 421, it would take 21 years to pay it off. And we're going to go through it again and see how long it took in our example here. And I'm going to use different colors, and we will send you actually the printout of the colors if that's what you want when we get done. If you have questions, don't understand, please do hit either chat or the Q&A and we will answer them for you. All right. So on the very first contribution, he put in 20,000 and we borrowed 10,000. And with that 10,000, we paid off Home Depot, Target, Chase, and a little bit of Barclays. It went from 300 to 290, or so it saved $10 a month. This was 228. This was 200. 200. We spent 10,000. That saved him 638, or we rounded it up to $640 a month. He is now paying himself rather than these 4 creditors. Now, if you will see this in month 8, this went to $1,695. The reason is that number 5 right here, Wallace Practice, paid off under the normal payment schedule because he only had 7 months left when we started. So that paid off. We asked him, do you want to leave that $1,054? We rounded it to $1,055. The only reason we do that is Ray likes even numbers. And so we made it $1,695 a month. He said, let's leave it in. We've been paying it for 10 years, so we'll go ahead and recapture it. But if he said, no, we don't want to leave it in, take it out, we would have stayed at 640. He's in control. He made that. Now, question you should always ask, did he have to work any harder? No. Did he change his cash flow? No, but he changed the direction. This 640 is now coming to him where it was going away. So yes, we changed the direction, but not the amount of cash flow. How much risk did he take? Did he ever lose control of his money? No. Now, he said he could save $100 a day. He worked 200 days a year. That's how he got to 20,000. So it started the 13th month. And I'm going to change colors here on you so that we actually have a new color. And one of the things I want to do before I do that, and I've already messed up, is go down here and show you we are taking loans 6 times. 1, 2, 3, 4. The next one it is a loan, but I'll show you, we'll catch it. 5, 6. Okay. So we're going to go down here and I want you to mark 6 years. So 1 first year, 2nd, 3rd, 4th, 5th, 6th. And we spent $10,000. Now I'm using round numbers. I know it was 10,450, but we're just using 10,590. Okay. Second year comes. Let's get a different color. Let's use red. We spend 20,000. He has 11,325 and $12,950. That came from this right here. That is the money he would have paid to other people. So it's in his segregated account plus the 11 gives us a total of $24,000. Now, at 24,000, we paid off Barclays, we paid off US Bank, we paid off the IRS, we paid off First Bank and Trust, and we dropped the Sears loan from 11,900 to 9,000. Okay? So adding those debts up, and this was $70 a month, this was $725, this was $425, $250. This was already paid off in $290. Those amounts added to $1,695 give us a $34.55 a month. Now, what we want to do is account for this $24,000. So we're going to go down again, and this is the tedious part, but I want you to track this. The $10,000 is being recirculated for the second time, and the $14,000 for the first time. Those two gave us the $24,000. Please keep this in mind. It's going to become very, very important as you see the recirculation of money, because we're paying those off, now becoming creditors. It's coming back to him. So we're doing that. We're 13th month, we did it. We're now saving $34.55 a month. The 25th month comes up. We're going to get a different color again. We use this word green. We put in the $20,000. We borrow $18,000 from the policy. We have $41,455 in our segregated account from the money that would have been sent to the people we had paid off, plus 18,000 gives us $59,000. Now, we had paid off 24,000 previously, so 59 minus 24 gives us 35,000. Now, with this 59, we paid off the rest of the SEER cards, First Bank and Trust, second loan, second chiropractic practice, second loan to First Bank and Trust, and we paid off those. Now, we have been in the program for 25 months, and we have paid off 12 of the 13 debts. How are we doing? I think we're doing pretty good, since it was going to take 21 years. Now, let's account for this 35,000 now, additional money of the total of 24. So we're paying $10,000 for the third time, 14,000 for the second time, and 35,000 for the first time. Each of our dollars are being recirculated over and over and over again. So I'm just wanting to keep track of them, show you how it's working, and we go back. And now we're on the beginning of the fourth year. Let's get a different color again. I get crazy with these colors. We're going to go with pink now, hot pink. I'm not trying to prove anything, believe me. So we pay our fourth premium. We got 19,000 of that available, and we got 66,000 from the money that would have been paid to other people. It is now in our account. We're able to recirculate it. We've got a total of $86,000. Since this 59 is almost 60, I'm going to say we take 86,000 minus 60, $26,000. Now, with that $89,000, what did we do? We had paid off Ray's loan, and we paid the house down from $95,000 to $15,000. Okay? Now, I want you to notice something here. I'm going to change colors on you, but before I want to go work on this 86,000, we're going to show where it went. We got 10,000 for the fourth time, 14,000 for the third time, 35,000 for the second time, and 26,000 for the first time. Okay? That's where the money went. Now, if you will notice, we took a loan 3 months later and paid off this debt. So I'm going to change colors on you again. I will come back and account for it. We'll go with the crazy purple. Paid off this debt. And then at the end of the time period, I wanted you to notice a couple things. What happened to his premium on the first policy? Went to $8,000. Okay? So, and it grew 10. So that's over a 25% growth. We never want to stop that. So we started the second policy because he was used to spending $20,000 a month, making a year, making no profit. So now we started. That is the longest you should ever wait to start a second policy is 4 years to 5 years. This is the start of the fifth year. Okay, we're doing that. And that has cash. So policy number one had 10,000. Policy number two had 10 plus $62,000 here. is 83,000, but we also used this 14. So if you add all the numbers up in the loans, it comes to $97,000 during that 12-month period. We took this 14 after 3 months and paid off house number 2 right here. So I just wanted you to see that. This is 97,000. So 97 minus 86 gives us 11,000. Let's take that into account. So we got 10,000 for the 5th time, 14,000 for the 4th time, 35,000 for the 3rd time, 26,000 for the 2nd time, and $11,000 for the 1st. There we are. Now, what happened is we started, and 8 months later, on the 57th month, let's change colors again. Go with a maroon. Okay. So it's right here. And we take $61,000. Well, what is that really? And we pay the loan totally off. Well, what is that? That's really $10,000 for the 6th time, $14,000 for the 5th time, $35,000 for the 4th time. And we take $2,000 out of this, and we got our total of 61. But I wanted you to really get it into your mind, your system. We used $10,000 6 times, $14,000 5 times, $35,000 4 times, 26, and we didn't have to use it all the 3rd time. Okay. Yeah, I'm going to do some things that'll help you get a little bit of the math understood here. I want to do this. How much did we pay in premiums? We paid $20,000 in premium for 4 years. Then in the start of the 5th year, we started a second policy, paid 20 on it, and 8,000 on policy number 1. So we paid $28,000 for 1 year. So we paid a total of $108,000 in premium. Not bad. Now, what I want you to realize is how much did we take out in loans? Well, let's go back and take a look. Well, we took, let's go through 8. Yeah. 10,590, 11,325. $10,590, 11,325. And let's go back. And we took 18,405 and 19,950. Yeah. Okay. We also at this point got one more loan we got to take, and we'll go back and we'll check it out. Is these two loans right here of 10,000 and 10,000. And that's a total of 20,000 for 20,005, I think. Anyway, not sure, but I know this. The total on this comes to $80,725 is actually what we took in loans. We paid off $421,000 in debt, and we have a lot to recapture. This was starting a policy from fresh, right from day one. Only one time, I want you to realize this, only one time was there a profit on the premium. Now, what I'm going to show you is a couple of examples of individuals of how this recirculation really works. When the numbers get bigger, they can be smaller. This was what I would say is an unusual case because the individual was really stressed out. He had been misdiagnosed with Lyme disease for 2 years. And what I saw, all these numbers, I saw somebody that was just trying to get through, make sure it was going to make it, and I believed he was. He was getting better. He'd been treated for the Lyme disease, but he was still weak, but he was starting to practice again. So he did this. This individual now has 6 policies. I got to see his 2 sons graduate from the University of Minnesota, and he's still working and using the system quite effectively with his family and his relatives. But what I want to show now is what can we do for somebody with big numbers and not so big numbers, but they go into big numbers over a period of time, and show you the passive income ability of the infinite banking private family financing when it really expands to it. Now, I want you to realize again that we use $10,000 6 times, 14 5 times, 35 3 times, every one of them 4 times, 26 didn't need it the third time, and 11 once. But each time the money is just being recycled because you're now bringing the money back to yourself. So we had an individual that brought this all about and made us think about it in December of 2019. And what you see on the screen is what took place from December 15th to October of 19. Actually, his policy was in October. So he paid the 15, 16, 17, 18, 19th. He paid 5 premiums, okay, of $60,000 each. Now, he bought some additional policies during that period of time. We'll go through that. But he wanted to know how he did on the original policy. And boy, I was saying, oh, I hope he did okay. And then, and we showed him he was supposed to have $301,000 of cash value, and we had 297, so he was happy with that. And what this shows is over the 5 year, actually it's 4 years because we only paid the last premium. So we're actually in the 49th month. He spent $1 million. And as I showed you on the previous example, it wasn't profitable until the 5th year. So we know we can't take $1 million out. We were only able to borrow $875,000. Let me erase that so you guys can see it. There we go. So we only took loans of $875,000, but we actually paid off debts of $1,328,000. Now, if you look at the $1 million going into the $1,328,000 over the 4-year period, we can actually say it benefited him from working with us for 4 years, $80,000 each year, because 80 times 4 is 320. But if you look at just what we're able to borrow, the money we had to use was $875,000, and we paid off $1,300,000 in that time period. And so that's $500,000 over the 4 years is about $125,000. Both numbers are okay. It showed by benefiting and working with the banking system that this was a start from scratch program. So you know that this money had to be recirculated number of times to make this happen in this short a time period. In other words, and that's what it was. As you can see, we had a 36 month must have been recycled as 57, 33, 36, 6 months, 8 months. All this money got recycled. So it's things that are taking place and doing it. And this individual, I want to point out, has a special program now that just does for his income taxes. Okay. And you can see that he's taken loans for his taxes 3 times already. Now, we did 17 GPSs on this individual over the 49-month time period. So we were doing them about every 3 months, and you do that rapidly. We didn't show that in the first example. We only show it annually, except for the one loan where we paid the house number 2 off. We did it after 3 months. So if there's a lot of money going into the segregated account, we speed it up or we slow it down. This is pretty good for passive income. But what I'm really excited about is, what does this do over the long run when you have policies that are really producing? Here's our second example. This individual started working with us in 2008. So he's been with us 12 years. His first policy was for $5,000. He was underwater on 2 mortgages in California. This was 2008, 2009. His wife was the main breadwinner, and she was pregnant with their second child, wanted to be an at-home mom. And so things have changed rapidly. They've been able to move. But from April 2014 to November 2019, that's 5.5 years, 66 months. This individual's total premiums were $780. That's not cash, but he borrowed, and again, I'll erase that so you can see it. $636,000. That's what his loans over that time period. But we paid off $1.9 million in debt. That's a 3-to-1 ratio. We can't be a regular bank, but we're getting able to recirculate by how fast we circulate these time periods. This is a 24-month. This was 36, 48. These time periods are able to pick up, go around. He's now into really long time periods, and we're still able to pay things off with this kind of money. So what I wanted you to see is, the longer banking goes, these ratios become very, very significant. where you can have huge passive income and various things. Because I want you to see this loan right here was $250,000 that he actually loaned to a person. Great collateral on it. Do you see the interest rate that he's getting on that loan? They're paying it back and doing it. But this was an equipment loan, a student loan, his new office. Paid off policy loans. The loans he'd taken, he wanted to recapture the money. Do you see how much he had borrowed previously? He wanted to recapture. He bought a new office building, his primary residence, rental house, monthly expenses, all kinds of things are going on here that he's doing besides taking over attorney fees and mortgages. So what I wanted you to see that the PFF system, private family financing, IBC, can accomplish a great deal. The longer it goes, the better it gets. And we want you, if you're not using this, what I mean by that, if you don't have a GPS system with the loans on it, payments to it, we now break this out for you. If you'll be disciplined, you can become very, very wealthy in just recapturing cars, loans, and various things to you and your family. And will help you and assist you in doing these things on a daily basis. Now, I'll open it up. That's pretty much, if you want this, again, I will send you everything I wrote out and send it to you because we want you to have it if you want to study it. If you want one of your own, you need to get in touch with us and we'll do that as well. So let me go over here to Q&A and see if there's some questions or various things that people want me to answer stuff. Let's see, Q&A. Okay. No open questions. Nobody open? Dismissed. No questions. Let me see about the chat. Okay. Got two under the chat. What is a segregated account? Okay. Segregated account, I'm glad you asked, is just a joint checking account that is maintained right where you bank, but it separates the borrowed money of the policy so that you can track it. And our GPS it's just a financial GPS system. Why we call that is money does not wait for us to make a decision. And you've been driving your car, get a phone call, gotta go someplace else, not sure where it's at, and you enter a new address or location in your GPS system. That's the same thing you do with the financial GPS. Money doesn't wait. Kid had a wreck. Car needs to be repaired. We need $2,000 for a deductible. We put it in the GPS system to show you how to recalculate and pull it from it. Or we need private schooling, or we had to buy a new instrument for the kid, or like we just had a phone call on Monday of this week. That was yesterday. And the air conditioner in his office went out and it was $11,000. He wanted to know how to get it and what it takes to pay it off. So various things. Now, I got a question here. Does it make sense to take out a policy loan for a vehicle that has already been paid off to recapture it? And I'm going to give you my answer. I say yes, because if you haven't done that, you can refinance a vehicle just like you can refinance a car, a home, or a house, or a rental property by increasing the interest rate, various things. And I'll put this on the screen so you can see. This is something I wasn't planning, but I think based on that question would be good to have. And what you see, this is actually a car model. And let's say here, we're saying that's it. And the car was $50,000 and it's paid off. Now, 3 rules that you have when you work with the system is 1, pay yourself. 2, pay yourself interest. 3, recapture versus payoff. Now, we've all been taught to pay off the car, pay off the credit card, to pay off the house, but we've never been taught to recapture the money. And what I mean by recapturing is we get all the principal, all the interest back, plus a profit. Now, we can isolate a loan with any of your policies, and once the policy is 2 years old or older, it will be, you can see the profit motive. Sometimes you can do it after 1 year, but most of the time it takes 2 years. This policy here is 7 years old that we're using as an example. We took 50,000 out. Now, this is column 1. Here we're not putting any money in. Column 2, interest, and 3, recapture. Okay. So this is exactly $1,000 a month or $12,000 a year over 60 months or $60,000. We took out 50, we put in 60. Took out 50, put in 60. So we spent $10,000 more than we took out, and it had to be interest since the 50 was principal. And the policy grew from 159 to 207 over that period. That's $47,000. Now you put 10 in. Would you put in 10 to get 47,000? Just wanted to know. So I would, and have had cars paid off before I knew about this, and then I went back and recaptured it. It depends upon the age of the car and whether you're going to give it to a child or a grandchild. So that's another interesting point. Got another question here. It says, what if you can get a lower interest rate financing outside? Would it still be a good option to finance via the insurance system? The way I'm going to answer that is yes and no. And the reason I say yes is because most people, when I'm going to draw a picture we saw earlier today. Let me do this, see if we get clean. Looking for a clean screen. Okay. Let me do this. No, what I'm going to do. So you guys can have all the pictures. And it was very, if you can, whoops. Okay. This is the cash value of your insurance policy, we could say. And you can earn 5% on this amount or 11% on this amount. Which one do you think would produce the most? So it's generally the policy. So right now, I am borrowing money from banks, conventional banks, at a low interest rate and putting them into policies and other things. So I'm using it as collateral. So I do borrow at lower interest rates if you can get it. The one thing I would tell you is do not let the nickel hide the dime. What I mean by that, most of the time we look at the principal and the interest. Well, the interest is never as much as the principal, except with houses. That's a different situation. But even with the current low interest rates, it's not. And we're worried about on a $50,000 car what the rate is, and I paid $10,000, but I got 50 back. Now, the example I would use, let's use 0% interest. You will only pay $50,000 in. In my example, you still lost the 50. You didn't get any of it back. It was all gone. In my example, you paid 60 and you got it all back. Which one was really cheaper? So you can't absolutely say always with lower interest rates do it or higher interest rates. And again, the time period is something, but I think it with our low interest rate environments, you definitely have to look at it and realize the insurance policies over a long period of time are doing better than the low interest rates. So that's one sense. Okay. Let's see if we have any other questions. And if we don't, and if you want that again, email ray@livingwealth.com and I will send you everything I did today and send it to you. It will go via email. So please give us your email address if you write to us. Okay, let me see if there's any more questions and answers. It says there are. Open. Oh, here. Last example, how much premium was paid? And I will do each example. Example 2, total premium was $780,000. Example 1 was $1 million. And the example I used was 108,000. So I hope I answered that. Bill Loving, yes, I'd like a copy of it. Okay. Should I pay off loans that have a lower interest rate than what insurance company charges me? Again, I think I answered that. If you're not going to recapture your money, I would love to show you an example where you can do that. So if you would like an actual example, whoever asked that question, please give me an email and we'll show you. It can be advantageous, not always, but you're looking at the rate. And the problem is many people don't even recapture the rate or that, just the other person. So it's not how much you pay, it's how much you can get back. Good example, again, I'm going to sell you a car, 0% interest. Let's say it's $25,000. And so you're going to pay just $25,000, but when you get done, oh, you got this car, you got none of the money back. Now I'm going to sell you the same car, let's say at $30,000. You're going to pay $5,000 in interest, but I'm going to give you back 25,000 of the 30. So the real cost was only 5,000. Which deal do you really want? So it's not a cut and dry answer, but we want to help you learn banking. It's controlling your money. Who's going to be in control? And that's why you would do it. Is there a reason why you wouldn't pay off a loan when you have the funds from the premium payment segregated account? If the money's there and there's a loan and you get a repayment schedule set back up, the most important thing about every example I gave you today, from the one where we ran the numbers and went through it to example $1 million, all these people were very, very disciplined at paying themselves back and recapturing the money. So if you don't do that, the answer is yes, it's not advantageous to always take a loan and pay something off if you're not going to do something with it. Let me see if there's any more questions. I think there are. What happens at death at 100? The policy matures. Is the payout taxable? Not yet. What the companies do, even let's say past age 100, they're making the policy death benefit continue to increase 5% more than the cash values. So it will always be a life insurance policy is what they're doing. That just happened to a couple of companies and they actually had that. So currently they're not taxable if it's a payout. So I just wanted to make sure we were clear on that. Okay. What does my PFF, how does my PFF continue on in my family after I die? Well, if let's rather than you die and let's kill me, I die and we have a quite a large family banking system. All that does is fund the current policies we have and put the money in to loan out and do other things. So banking, if you think about it, just because a policy, a sure, you have an account holder. I'm sorry about that. Account holder at a bank and they die, that money is still there. It can be transferred to the other family members or out. Same is true with your PFF. You may die and there will be a windfall from the death benefits, but the family still needs a banking system, so that can be the good basis. Policy actually transfer ownership, not upon a death. The policy is done for the death benefit is what we call a windfall profit coming in. And last one, after 5 years, is it a good idea to stop funding, use money, start a new policy? Yes and no. Again, I would say it's always good to have another policy, especially if you're making a profit from the current policy to start another one. But if you have the funds, I would never stop funding the basic policy, but I would want multiple policies. Wealth has to reside somewhere, so I'm not really saying to stop funding it, if that makes sense. Okay. Let me look at one other thing. If I come into extra cash, how can I put it into my policy if I'm already paying max premium allowed? The max premium and the amount that it would met are two different numbers. We might have calculated it, might allow it. If not, you would need to open another policy or put it into one of the policies that would allow the contribution. We have many savings accounts, it's okay to have numerous policies. I have over 50 policies. And so I always can find some place to put the money, and they're all funding very well. What I mean by that, they're all but 3 of them are profitable. What I mean, they grow by more than the premium I'm putting into them. Okay. And I don't see any more questions. Yes, I do. When a parent passes ownership of a policy to their grown child, when the child is insured, is that a taxable event for the child? It could be, and what we would, there's a couple ways to do that. If you would call, I would do it. The child automatically becomes the owner upon your death and gets a stepped up basis there. And there is a way to do it while they're alive if you want them to be the owner of it. And it depends upon what the cost basis of the policy is, whether it becomes a taxable event or not. And we can show you how to do it so it will not be a taxable event to the adult child, if you want to know that. Okay. Boy, this has been great. All right, we are done. Thank you for taking the time and spending the 50 minutes with me, 51. I hope you felt like you benefited from it. Just again, ray@livingwealth.com. If you want any of the printouts from the material we used today, be happy to send them to you. Thank you. God bless. Have a great one.